So when December 1st hits in just a few weeks, this will mark the 10th month of many companies working entirely or partially remotely here in the US. When all of this started back in March, articles and news outlets were pretty quick to mark the office sector as dead in the water, but at that point it was all just speculation, with so many unknowns about how the economy and the nation as a whole would fare throughout the rest of the year. But now, well into the fourth quarter of 2020, we're finally starting to get some data around what kind of effects that remote work and the economic situation as a whole we're in right now are having on office space. And we're also starting to see how companies are responding with their leasing decisions, which directly affects rents and property values in the office space as a result. So is office space as we know it really dead? And what is the data from this year telling us about the potential short and long-term impact on office real estate in 2021 and beyond? That's what we'll cover in today's video. Hey, this is Justin from breakintocre.com, and if you're new here, on this channel we talk about real estate investing careers and real estate investment analysis. So if you're looking to break into the industry or do your first or next commercial real estate deal, make sure to subscribe to the channel and hit the notification bell so you don't miss any new videos as soon as they're released. So with many companies across the US implementing work from home policies starting in March and April of this year, remote work has continued throughout the rest of 2020 for many corporate offices, and with reopening plans being halted in many US states as we head into the winter months, this will likely continue into at least the beginning of 2021. And this has all created some sort of a forced experiment for office users to see if this whole remote work thing really works on a larger scale. And there was a lot of speculation swirling around when shutdowns first started regarding whether or not companies would actually buy into these work from home policies long term, with major companies like Twitter and Facebook announcing more permanent work from home arrangements, and even more conventional companies like JP Morgan announcing more widespread work from home policies during this time as well. But in March and April, it was anyone's guess as to how this was actually going to play out. But at this point, heading into December, we're finally starting to see some data on how the office sector is adapting to these changes and what kind of effects this is having on vacancies, rents, and values for office properties as a result. So in this video, what we're going to do is talk through what's happening in office real estate right now and what these trends might mean heading into the new year and beyond for office investors. So first, and not surprisingly, on a national level, office vacancy has increased and net absorption has decreased significantly over the past 2 quarters. According to the CBRE US Office Q3 2020 figures, the overall US office vacancy rate jumped by a full 1 percentage point between Q2 and Q3 of 2020, which represents the highest increase on record since 2014. And net absorption numbers, or the total amount of space that becomes physically occupied minus the total amount of space that becomes physically vacant, was negative 33.5 million square feet in Q3, according to CBRE's report as well, which also represents the largest quarterly decline in this number as well as the biggest drop CBRE has seen in almost 20 years since 2001. And if you put together Q2 and Q3 net absorption data, the US as a whole saw negative net absorption of 54.9 million square feet from April through September of this year, which is even worse than the numbers we saw during the entire Great Financial Crisis between 2008 and 2010. Also unsurprisingly, the cities that top the negative net absorption list in CBRE's report included San Francisco at 4.2 million square feet, Los Angeles at 4.7 million square feet, and Manhattan alone at a massive 10.3 million square feet of negative net absorption. Almost 90% of the negative net absorption across the entire US occurred in California, Texas, and the Northeast corridor between Boston and New York, while Southeast and Midwest markets like Tampa, Minneapolis, and Milwaukee saw the least significant hits of all cities in this analysis. And this also might spell trouble going forward for many of these cities with significant supply coming online in the next 12 to 24 months, especially in more expensive markets like San Jose and Austin. Both of these cities currently have over 10% of their existing office inventory under construction right now, which amounts to over 6.1 million square feet of office space for Austin and over 10.5 million square feet of office space in San Jose. And even without this additional square footage available yet, both of these cities have already seen significant downtown vacancy rate spikes in the last year, with Austin vacancy rates moving from 5.8 to 10.3% between Q3 2019 and Q3 2020, and San Jose vacancy rates for downtown office space jumped from 10.1% to 15.6% during that same time period. As we often talk about on this channel, the combination of increasing supply and decreasing demand is a very clear indicator of rent and property value decreases in the future, and these cities and others that are seeing similar trends could be in for quite a bit of trouble heading into 2021. Now, interestingly, on the supply and demand note, another important finding from CBRE's report is that asking rents haven't dropped yet, even with the significant uptick in property vacancies we've seen this year. Average gross asking rents actually rose by 90 basis points between Q2 and Q3 of 2020 and were up by 3.9% year over year between Q3 2019 and Q3 of this year. So instead of decreasing rents on new and renewal leases, it looks like office owners are making every attempt they can to preserve exit valuations based on NOI values in the future, and with that, owners are opting to offer things like free rent or tenant improvement allowances upfront rather than decreasing contractual base rent values for the entirety of the lease term. And these asking rents haven't just stayed steady for new leases, but also for a significantly high amount of renewal leases as well. As is common in economic recessions, renewal activity has increased significantly this year as a percentage of total leases signed, with renewals accounting for 29% of all leasing activity in Q2 and Q3 of this year. This data was included in a recent report released by Cushman & Wakefield, which also found that this 29% number is significantly higher than the historical renewal percentage average of just 19%. The Cushman report also found that many companies have been downsizing their office footprints this year, with 34.5% of renewal transactions being signed for less space than the previous lease term, which is up significantly from the historical average here of only 19.7%. And finally, aside from vacancies increasing and company downsizing, we've also started to see a shift in lease duration for new and renewal leases signed this year. One of the biggest speculations on office space in the beginning of this year was that flexibility would be prioritized more than ever by office users and that lease duration would decrease as a result, and that has proven true and has played out this year. According to that same Cushman & Wakefield report released earlier this month, the average office lease term in Central Business District or CBD locations for 2020 was 5.75 years compared to the previous 10-year average in CBD locations of 6.44 years. In suburban locations, this number also dropped to 4.51 years compared to the previous 10-year average for suburban leases of 4.9 years as well. And part of these average numbers dropping could be due to the fact that many very short-term leases are being signed this year, with over 31% of all renewals signed in 2020 being for leases shorter than 12 months in term, which is significantly higher than the historical average of just under 19% for short-term leases. And this makes sense with so much uncertainty as to what lies ahead as we move into the winter months, and as this whole work from home experiment continues for many firms across the country. So with all of that said, and finally a few data points starting to paint a picture of what's happening in the US office market right now, what does this mean for the office sector during the end of this year and into 2021? Well, as an overall blanket statement, things are not looking great for the office sector as a whole as we wrap up 2020. With over 125 million square feet of office space under construction in Q3 and demand still relatively low in many major cities, office vacancy rates are likely to continue ticking upward, and asking rents will likely begin to fall later this year and into 2021 as a result. According to a recent CBRE occupier sentiment survey from September of this year, less than 37% of respondents plan to return to the office in Q4 of 2020, and less than 60% of respondents plan to return to the office in the first quarter of next year, which is also another likely indicator of at least another 6 months of negative net absorption numbers to come. As with any major down cycle though, opportunities always arise when distress hits the market, and even with a potential decrease in office demand over the short term, there will inevitably be deals hitting the market next year from owners who are over leveraged and in a cash flow crunch due to vacancies and new supply coming online in major markets, even in popular markets like Austin that are still seeing employment growth. And investors who are willing to weather the storm and are able to acquire well-located, well-built office assets, in my opinion, there's still significant long-term upside in the right office investment opportunities in 2021, even if we might continue to see some more headwinds heading into the new year. So I hope that was helpful if you're an office investor or you're looking to get into the office space. And if you're trying to take advantage of potential investment opportunities that might come up next year and want to be prepared with your analysis, as always, make sure to check out Break Into CRE Academy, and I'll link that in the description below. And also let me know in the comments which office markets you're bullish on right now and why you like them. And if you like this video and want to see more content like this on market analysis and current market events, make sure to like the video to let me know, and also make sure to subscribe to the channel so you don't miss any new videos as soon as they're released. So thanks so much for watching. I hope you found this helpful, and I'll see you in the next video.